Tēnā koutou katoa, welcome all, and in the spirit of Sign Language Week, which means have a happy Sign Language Week. It is my pleasure to be here today to obviously announce our May 2019 monetary policy statement. It is actually also an honour to be delivering the first monetary policy committee decision. I'm pleased to say the decision was unanimous, so no vote was needed. As you're aware, we are now a decision-making committee of 7 people. However, only 6 were involved in this round. We had an apology early on upon appointment for Dr. Caroline Saunders for this particular meeting. As Governor of the Reserve Bank, I am the chair of the committee and I'm also the spokesperson of the committee for the purposes of this announcement. Beside me, I'm very proud to introduce Mr. Yung Ha, Chief Economist of the Reserve Bank of New Zealand, and beside him, Mr. Christian Hawkesby, who is the Assistant Governor and General Manager of the Economics, Financial Markets and Banking Group. Also in the room and in the privileged front row position here, I have Mr. Jeff Baskand, who is the Deputy Governor of the Reserve Bank and well known to you all, and I'm very proud to introduce both Professor Bob Buckle and Mr. Peter Harris, who are our external, 2 of our 3 external members to the Monetary Policy Committee. And as I mentioned, Dr. Caroline Saunders will join us from here on in. So it is the beginning of a new decision-making period for the bank, and I'd have to say it was unanimous and very productive. And I do hope that the richer document, in particular the record of the meeting that you've had to absorb over the last hour or less, has provided a lot more context for you. So thank you to the Monetary Policy Committee. Today, the official cash rate has been reduced to 1.50%. The Monetary Policy Committee decided that a lower OCR is necessary to support the outlook for employment and inflation to be consistent with our policy remit. Global economic growth has slowed since mid-2018, easing demand for New Zealand's goods and services. This lower growth has prompted foreign central banks to ease their monetary policy stances, supporting growth prospects. However, there is uncertainty around the global economic outlook. Trade concerns remain, while some other indicators suggest trading partner growth is stabilising. Domestic growth has also slowed from the second half of 2018. Reduced population growth, in large part through lower net immigration, and continuing house price softness in some areas has tempered the growth in household spending. Ongoing low business investment sentiment, tighter profit margins and competition for resources have all restrained investment. Employment is near its maximum sustainable level. However, the outlook for employment growth is more subdued and capacity pressures is expected to ease slightly over 2019. Consequently, inflationary pressure is projected to rise only slowly. Given this employment and inflation outlook, a lower OCR now is most consistent with achieving our objectives and provides a more balanced outlook for interest rates from here. Mei Taki, thank you very much, and we are open for questions.
Hi, I'm Matthew Brockett from Bloomberg News. Your policy statement today doesn't give any indication of what might happen to rates going forward, but your forecasts have half of a cut over the coming year or so. My question is whether you still have an easing bias in place.
We think we're in a good position to be able to observe the data as it unfolds. So you're correct, our forecast track has a slightly lower path than just one cut, but the uncertainties around that path are large, as I think well illuminated, illustrated in the record of the meeting. So we are in a position to be able to absorb the data.
And just a second question on growth. For some time, if I think back to last year, you were looking for a fiscal impulse to boost growth, and that never seemed to arrive. Do you have any sort of thinking around where that disappeared to and whether it still might show up at some point?
The fiscal impulse has arrived. It is in the document. It is in the projections. And we expect that to continue throughout the course of the next 12 months or so. So the fiscal impulse is there. We'd be more surprised to the downside around ongoing weaker than projected business investment and consumer spending, coming down from around 6% growth per annum down to around its 3% growth rate at the moment. A lot of that, in part, has been spurred by the slower global economic growth and the weaker impetus from global trade. So they've been the surprises rather than the fiscal impulse. Would that be correct? Yeah.
Thank you.
Hey, Brian.
Brian Tallow, does the suite of labour market indicators that you look at include the PAYE take? Because on the face of it, they would suggest either stronger jobs growth or stronger wage growth than the survey-based indicators are picking up. And if you don't look at them, why not?
Young, do you want to cover that off?
It's not in there directly, but it is an ongoing area for research for us. So as we learn more about the labour market, we will pick up a broader range of indicators to help inform on what's going on there.
Very quiet audience today.
Hi, this is Praveen from Reuters. You mentioned in the record about immigration being an issue as well. So how big an issue is that for going forward?
It's an issue in two senses. One is that it's been a significant push in population and consumption growth, and so it's been a very strong positive impetus. It still is a positive impetus, but less than what it has been on the way through. Another part, and not necessarily for long-term immigration, but actual just visitor arrivals, we do have the data gap, the technology. Christian or Young, you on the how we're interpreting the new data?
That's right. Statistics New Zealand have changed their approach to determine the long-term status of migrants coming into the country. We don't think that's fundamentally changed our assessment of the outlook for monetary policy. Population growth has slowed over the past few years, and that's one of the reasons why there has been some steam taken out of domestic economic momentum, and we think that's going to continue over the next couple of years.
India Leishman from One News. I just wanted to ask whether you're worried whether this will heat up the housing market.
I won't say worried. We anticipate that with lower interest rates, it does free up cash, and if people choose to be investing in the housing, then that will be their choice. We notice, some members, it was interesting, thought that given these lower interest rates, we might end up with more of a house price impetus, but it wasn't a unanimous view across the committee. But we do expect to see the impulse from lower interest rates to come through spending and through investment activity, and part of that would be housing activity.
For people trying to save, do you think this is going to be disappointing?
I think there's always two sides to interest rate. There's the savers and the borrowers, and yes, it's lower than otherwise interest rates, and they may need to be thinking about what things other than just deposits in a bank they could be doing with their capital.
Okay. And just lastly, are you worried how the US-China trade war and falling US markets may affect New Zealand?
We are. We put that as one of our major concerns. One of the downside risks to global economic growth are trade barriers, and we've seen the trade fall off quite dramatically over the last 9 months or so, in part related to the trading uncertainty. That is a large part of what prompted us to shift, to talk about an easier bias before. So that remains a concern. I can't say whether we're any closer to resolution or not as I stand here, but global trade is incredibly important for our economy.
Bernard Hickey from Newsroom Pro. How low can you go before you're flogging a dead horse?
Monetary policy has many different means by which to stimulate spending. We have no evidence that it is any more or less effective than it has been in any past time in history, even though we're at a low nominal interest rate at the moment. As you know, and I would reference people, and I have done in the past, Bernard, to documents were printed here around zero abound, what alternative means of easing monetary policy, if that was needed, are available in the future. And we've seen all of those used in part globally, and some of them here domestically during the global financial crisis. So plenty of scope to do whatever is needed. And our projections is that we've done about enough for what we can see at present.
So how low do you go before you get some diminishing returns, that you get close to that zero bound and you start to not get much
I don't
traction?
buy into a diminishing returns concept, so I can't really answer that question.
And what do you think the risk is that the banks will use this as an opportunity to not pass on the lower rates to borrowers and use it as a chance to increase their margins, potentially in advance of higher capital requirements?
We hope it's a very competitive banking system, and that for those who want to increase margins, there'll be those who will want to increase customer base.
Hamish Rutherford from Stuff. Did the potential higher capital ratios play any part in your decision, or is there any sign of banks pulling back lending in advance that played any part in the decision to cut?
Probably two legs to that question, Hamish. The first one around the capital considerations or consultations we've got, no, it hasn't played any part in this projection. Submissions are still open. They close on the 17th of this month, and we remain an open book to hear what they say. I have to say I'm very pleased. We've had over 50 submissions to date, and we're waiting for the ones from the banks themselves. On credit growth sides, I would say all I've read is what's come through largely from the media out here around anecdotal discussions of pullback on lending activity in specific sectors. Anything to add just on the credit growth numbers?
No, I mean, we know the housing market activity slowed, and that's reflected in the bank credit growth numbers. So.
And banks themselves, you've seen open letters published in the newspapers and on the sides of some banks saying that primary sector will get nervous if capital requirements, so quite a bit of taiha waving related to what the capital may or may not do.
Janae Tibshirani from interests.co.nz. Governor, can you just explain in a bit more detail why you don't believe in a diminishing returns argument?
Well, I would probably flip it on its head. If we raised interest rates by 50 basis points here, as opposed to cut from 50 basis points here, would it be a real surprise and have a significant impact on monetary policy? I imagine the answer is yes. Likewise, it is symmetrical. There is no evidence that we can see, both domestically and internationally, that you have some sense of diminishing returns in the use of monetary policy. None of this is not to say that having friends in monetary policy is always useful. So we have said here that balance sheets, both corporate and household, are good. The government's balance sheet is remarkably solid at the moment, and fiscal spending is a net positive impulse to the economy. So, we're not the only show in town.
Wouldn't it then have made sense to wait, it's only 2 weeks from a budget, to wait and see what it... Sorry, wouldn't it have made sense to wait 2 weeks and see what the budget says if you're trying to forecast supply and demand ahead?
I like the question. I think it's a very good question, Brian, and we've thought about it a lot. The good news with monetary policy, it's a repeat game, and we can take on information as it comes. What we decided, you're always waiting for that one new piece of information. Is it the labour market? Is it the new wage data? Is it the housing data? And the budget itself, we've been using the December fiscal year update. We've been running scenarios. The answer is whatever may come within the long-term fiscal parameters, constraints that are there, monetary policy can easily accommodate that through time. By the way, it's not just as easy to say how much has been spent, how much is intended to be spent in any one day. It's also what is the spending? Is it adding to capacity or just outright demand? Is it a transfer of wealth from one sector to the other? And then the lags, the actual challenges of implementing that spending. So they are highly uncertain, which makes it much better for monetary policy just to get on with its job.
Would the Reserve Bank like the government to be more of a monetary policy mate by using its balance sheet to stimulate, to take some of the pressure off you?
I think government spending in total is set by the government of the day for long-term purposes of the people. So, you know, it's globally, it's never been seen as a particularly useful or timely business cycle stabiliser. Currently, as it is, New Zealand is in a good position relatively. And I've mentioned this before, and people misinterpret it to say, you know, oh, the bank's not interested in easing, and Mr. Orrs just said we're in a good position. What I'm saying is that employment is near its maximum sustainable level, inflation is very close to its target, the Crown balance sheet is extremely healthy, and government spending and investment is well planned. So, you know, we do have many options around continuing to grow and remain near full employment.
Why is inflation not increasing at a time when we're 10 years into an economic expansion and unemployment's near 4%? This doesn't seem normal. Can you talk about what are some of the structural issues that might be surprising you?
Yeah, I mean, again, very good question. And the good news is it's not unique to New Zealand, because we'd be really thinking hard. This is a global phenomenon, and we are a small nation, a small trading nation. So the first hint to that is simply positive supply shocks globally around technology and what it's done to the real price of goods and services, particularly goods, computing power, for example, same price, but infinitely more powerful outcomes, so the productivity in that space. A single global labour market almost effectively, so, you know, goods and services are produced continuously by the lowest producer base in the world, and we've seen those import prices coming through. I'd like to give a little bit of kudos to all past and governors of central banks around the world and present members of the Monetary Policy Committee, because inflation expectations appear very well anchored, and we have much better idea around what monetary policy can and can't do. So quite a conflation of productivity shocks, of global openness, and also, I would say, more sophisticated or more honest monetary policy behaviour.
Charlotte Greenfield from Reuters. Could you just explain a little more in the last paragraph? You say you've established a more balanced outlook for interest rates. Does that reflect a neutral bias going forward?
We deliberately put the more in there. If your forward path for the OCR track is saying down and then you've already moved down, well then obviously looking forward from there it's more balanced.
Nick Perry from the Associated Press. I just wondered, is there a new normal for interest rates now, both in New Zealand and globally? Because we seem to have drifted so far and so long from the sort of 3.5 to 4.5% range. And following on from that, do you think it is kind of impossible now to get back to those historic rates because so many people are reliant on it being so much lower, including homeowners?
I think if you answer yes to the first, you also have to answer yes to the second part of the question, in the sense that as long as inflation expectations are low and well anchored to our target, then nominal interest rates will also be commensurate, low and well anchored to our inflation targets, and that is what you have seen globally. When we say new normal, I always like to think it's normal within our short period of economic history, which is really since the 70s to now. It was the stagflation periods and then the battle to win back low anchored inflation and hence low anchored nominal interest rates, and we appear to have achieved that globally. And for most countries, I can point to a few who have taken their eye off the ball and have ridiculous situations, very, very sad economic situations. But yes, if you want to call it a new normal, call it that. I would suggest we're probably back to the original normal. The economic historians here, have I?
No, that's bang on. I think it's a global issue that's being addressed and is very much linked to that sort of potential growth, potential inflation expectations.
Can we also, just a supplement to that as well, we think about low consumer price inflation and low nominal interest rates for a particular purpose, but relative prices are still moving enormously within that aggregate price. We talked about the relative prices of computers versus haircuts, the relative prices of some assets versus others, and the relative prices of some currencies versus others. So relative prices are alive and well, but aggregate consumer inflation for now is low and stable.
Hi. The Kiwi dropped to a 6-month low after the decision was released. How do you feel about that in comparison to where it was this morning?
Sorry, you're from?
Reuters.
Oh, I thought so. You're looking for the exchange rate headline. I don't have any feeling about it.
Yeah, Lachlan Cahoon from Market News International. I understand this is the first decision you've made under your new framework. Are there any comments you've got to make on how that worked? And you said that it was a unanimous decision. Would you have made the same decision if not for this framework this time?
I won't answer the latter hypothetical question. Just to be clear as well for all listeners, so the new framework is a combination of several things. One, we've had our dual targets in operation for quite some time now. In fact, for the full period that I've been Governor, the maximum sustainable employment contribution and the inflation target. And so we've been operating consistent with that. And the decision that we were faced with over today was exactly aimed at the same things. What is new is that it was a committee decision. And from my personal view, it's gone extremely well, and I'm very proud of the record of the meetings. I believe that provides great context and richness to the documents, which prior to that were driven and too deterministic around a single line projection and one or two chosen risk scenarios. But colleagues, did you find it enriching?
I think I'd just pitch in there and say the thing that really struck me about the decision making is the very deliberate process that is run through. It's a week and a half process, very much initially led by staff and the analysis that they've done around the economy, the projections they put together, and runs through very deliberately around the key issues, the risks, the judgments, the strategy, and the decision is something that falls out very naturally once you've gone through all of that first part of the process. So I thought the process is designed very well to support a consensus decision-making
I'm sorry, I
structure.
don't like to fish too hard from the front row here because it's awkward that you've got your back to everyone, but any comments?
Good afternoon. I'm one of the three externals, Bob Buckle, and from my perspective, it was a very open and robust process, and very impressed with the information that we were able to work through to come to a consensus decision. So that was my perspective. Okay, Peter.
Yeah, Peter Harris is my name. I've got nothing to compare it with, of course, but from my first cut, it seemed to me to be quite a seamless process of adaptation, as Bob said, assisted by very structured and thorough background material and ample opportunities for discussion and comment.
Thank you, team.
Governor, what work has the bank done to prepare for the potential for interest rates to go to zero in terms of preparatory scenarios or what sort of tools you could use, those sorts of things?
We've done past and we're always doing ongoing work around how you might manage a situation where you needed different monetary policy. You're talking about a zero floor, it might be an extreme single one-off event. And really the work is related to around how negative can interest rates go before people actually just want to hold cash. How can we do direct asset buybacks if and when needed, which we have done in the past, mortgage-backed securities, for example. The team at the moment, Jung's team, are working very hard on creating a market for the mortgage obligations so that we have a pool of assets to be able to do this type of work. So there are varied means by which monetary policy can play an expansionary role even with zero interest rates. On the other side of it, of course, is what I like to think about is more in times of crisis when these issues are needed, and that is about making sure that all of the work that's been going on in the legislative review of the bank and how we practice is that the fiscal authority and the monetary authority, the Treasury and the RBNZ, know exactly who does what and what kind of checks we could write if and needed, when needed. So exactly that crisis management behaviour. The global financial crisis isn't that far back for some of us, and we got through that, but not in an optimal way, because a lot of it had to be made up on the way. And so it's as much about understanding who has the right and the obligation to do what during particular financial crises, if and when needed. That is a global phenomenon, by the way. You know, from the Swiss have been running negative interest rates for I don't know how long, and there are many examples around the world of it operating quite smoothly.
I can recommend the Bulletin article published in May last year that goes through all these issues very thoroughly and looking at the global experience and putting it in a New Zealand context.
Governor, what's your view on whether quantitative easing is actually a good idea when it looks like in the US and other places, all it did was pump up the value of assets and make rich people even richer? Are you considering the equity impacts of something like that?
I think monetary policy always has, in most part, an aggregate impact on the economy, but in some parts it always has a relative impact. For example, I was asked the question today, borrowers may be pleased, will savers be annoyed? It's not a lot different. Will they go off and those who own a house be much wealthier and make sure those who don't not be able to enter the housing market? There is always an absolute and a relative. In terms of the quantitative easing, there are some means by which some sectors will be more benefited than others. The important part is to get, one, the ability to manage a crisis well understood. Two, those who may be fronting or in part causing the crisis well capitalised, so that they are able to absorb a big part of the activity. And then the rest is about what happens to the ability of the Crown or a government to absorb on their balance sheet some of the risk, because that's effectively all you're doing when you're writing a cheque. You're shifting risk from one part of from one person's balance sheet to another to manage through those processes. And it's the best time to be thinking about these things is now, which is why we're doing all of the work that we're doing across creating markets for assets that could be bought, understanding what zero or negative interest rates do or don't do, and also around that crisis management and adequate bank capitalisation.
What's your view on whether a quantitative easing for the people, i.e. giving the money directly to people to spend rather than using it to buy bonds, or whether that's a better idea? Because one of the problems seen overseas...
It is one of many ideas, Bernard. So there is some kind of targeted asset buyback. And you're saying disintermediating the banks or whatever the intermediaries are and going to targeted sectors. That itself has significant relative economic impacts. So, who do we choose? Is it people in Taranaki and not Southland?
Governor, are you discounting the idea? Are you discounting the idea that some of the slowdown in growth you see might not be a want of demand, but the economy running up against capacity constraints? I'm thinking of the labour market and the construction sector in particular.
No, we put that in there as part of our core economic projections, and we also have that story around capacity constraints potentially being more than what we are currently observing as being a risk. So it's very clear the discussions we've had around it. One of our biggest challenges has been around investment in total. There are many components to that. There's housing, there's government, there's business investment, all competing for similar resources, all with equal desire to be growing and expanding. So the competition for resource is one of the areas we talk about as a risk to being able to grow as fast as what is in the projection.
Just the last one from me. You've got a new forecasting team head. Has the Reserve Bank revisited its modelling around the economic capacity and the structural inflation issues? And is it changing how it models these things in response to, you could argue, a failure over the last 5 years to get that right?
So the answer is yes, we are continuously reviewing the modelling framework, but no, not because of new people in front of it. And the continuous review is real time. We've got a room full of smart people, many who are surrounding you at the moment, who are continuously working to think about what are the core uncertainties. The first one is, where are we actually starting from? And that is always the biggest surprise for monetary policy. Relative to February, we're now starting in a much weaker global growth environment. The next one is, how does the world actually work? And that is about the modelling work. Are we seeing the relationships we expected to see from the way in which we have moved interest rates in the past? And as we've spoken about here before, the answer has been no, with caution. No, in the sense that people have been setting their prices more on behaviour of what they've seen in the past rather than what they expect in the future. And so that means that we've had to have more than otherwise stimulus in the economy to get the same bang for buck. And the last uncertainty is what's going to happen next. And today you've asked all questions related to all those three things. Where are we starting from? How does this thing work? And what do you reckon might happen next? And so that is the bounds of uncertainty. And we are continuously trying to learn and develop our frameworks for it. I might just we'll take one more. Yep.
You personally said in March that the next move for the OCR was likely to be down. How much of an influence do you think that had on the committee?
Yeah, I think I'll talk on behalf of the committee, and they can feel free to tell me I'm mad. But we start each forecasting round with the open book. This is where we believe we best are, and this is why we said what we needed to be doing last time. And that is the first, I suppose, day and a half of the meeting is just putting the facts on the table, trying to get a common starting point. Tell me I've lied in public. My mum's watching. So that's that's where we start from. I do notice that a lot of external economists have shifted from it could be hold to up to it could be hold to it could be down. And then I note that I then get written about I'm the one that's whipsawing monetary policy around. So I would probably let people step back and think about that. Is it a good one? One to go.
How difficult was it to decide to cut rates today? Was it a tough decision? And if it was a tough decision, what was it that tipped you over the balance towards a cut?
I think the exciting part in the, like all good stories, you have to get to the last couple of chapters, unless, of course, it's the press statement where we give it away at the front there. But in the record of the meetings, we talked about how we got comfortable with a central projection, how we got comfortable with the risks, balanced around that central projection, and then it was about, okay, if we're all comfortable, it is what it is in front of us, which said there's a cut on the table here, and then the interesting part is now or later, and that was that's the discussion. A stitch in time may head off other things, or what's the fear of having to reverse it, in a few weeks or in the next data. So that was the conversation, and I think that was not particularly difficult at all from where we're looking. Okay, thank you very, very much all, and thank you to our new Monetary Policy Committee. Mai taki, mai tā.